The South Sea Bubble, one of history's most infamous financial crises, occurred in the early 18th century in Britain. This episode not only exposed the fragility of early modern financial systems, but also highlighted the risks of speculative investment and corporate mismanagement. The South Sea Company was established in 1711 during the reign of Queen Anne as a public-private partnership designed to consolidate and reduce the national debt. The company was granted a monopoly on trade with South America, a region perceived as rich in potential wealth, although it was under the control of the Spanish Empire. The British government encouraged investment in the company, promising high returns on shares, which were to be exchanged for government bonds. The South Sea Company's promise of untold riches from trade with Spanish America captivated the British public. In an era where colonial exploits often led to substantial profits, the company's trade monopoly appeared highly lucrative. Investors, from the wealthy aristocracy to common merchants, were drawn by the potential for high dividends. Additionally, the company's close ties with the government lent it an air of legitimacy and security, further boosting public confidence. The speculative fervor surrounding the South Sea Company reached its peak in 1720. The company proposed a series of schemes to assume more of the national debt, exchanging it for company stock. As the government endorsed these schemes, public enthusiasm surged, leading to a rapid increase in the price of South Sea shares. By mid-1720, the value of the shares had skyrocketed from £128 in January to over £1,000 in August. This meteoric rise was fueled by a combination of aggressive marketing, insider trading, and the public's speculative mania. The company and its supporters employed various tactics to inflate share prices, including disseminating exaggerated reports of potential profits and offering easy credit terms for purchasing shares. The result was a classic financial bubble, where share prices far exceeded the underlying value of the company's assets and potential earnings. The bubble burst as quickly as it had inflated. By September 1720, the public began to doubt the extravagant claims of the South Sea Company. As skepticism grew, shareholders rushed to sell their stocks, causing prices to plummet. The sudden collapse left countless investors in financial ruin. The stock, once valued at over £1,000, fell to a fraction of its peak price within weeks. The aftermath of the crash revealed extensive corruption and fraudulent practices within the South Sea Company. Company directors and government officials were implicated in schemes to manipulate stock prices and profit from insider information. Investigations revealed that many had used their positions to amass vast personal fortunes at the expense of the public. The South Sea Bubble had profound economic and social consequences. The financial devastation affected a broad swath of British society, from aristocrats to ordinary citizens who had invested their savings in the company. The collapse of the South Sea Company undermined public confidence in the financial system and led to widespread economic distress. The crisis also had significant political repercussions. The British government faced intense scrutiny and criticism for its role in promoting the South Sea Company and failing to regulate its activities. Several high-ranking officials were disgraced and some faced legal consequences. The scandal prompted a wave of financial reforms aimed at preventing similar occurrences in the future. In the wake of the South Sea Bubble, the British government implemented several reforms to restore public confidence and stabilize the financial system. One of the most significant measures was the Bubble Act of 1720, which aimed to regulate the formation and operation of joint stock companies. The Act restricted the creation of new companies without a royal charter, intending to curb speculative ventures and protect investors. Additionally, the crisis led to greater scrutiny of corporate governance and financial practices. The government established mechanisms to oversee and regulate financial markets more effectively, laying the groundwork for modern financial regulation. The South Sea Bubble also highlighted the need for transparency and accountability in corporate operations, lessons that remain relevant in contemporary financial markets. The South Sea Bubble was not an isolated incident, but part of a broader pattern of speculative bubbles and financial crises throughout history. Similar events, such as the Dutch tulip mania in the 1630s and the Mississippi bubble in France around the same time as the South Sea bubble demonstrate the recurring nature of financial manias and their catastrophic consequences. These events underscore the cyclical nature of speculative bubbles, driven by human behavior, market dynamics, and regulatory environments. They also highlight the challenges of managing financial innovation and maintaining market stability in the face of speculative excesses. The South Sea bubble remains a cautionary tale of financial speculation and corporate malfeasance. Its legacy is evident in the evolution of financial regulation and the ongoing efforts to balance market innovation with investor protection. The lessons of the South Sea bubble continue to resonate, reminding us of the importance of vigilance, transparency, and prudent regulation in maintaining the integrity of financial markets. The South Sea bubble serves as a historical reminder of the perils of unchecked speculation and the necessity of robust regulatory frameworks to safeguard economic stability. As financial markets evolve and new speculative opportunities emerge, the lessons of the past remain crucial in guiding contemporary financial policy and practice.